Welcome to Mastering Investment Performance, a complete guide. Today, we'll dive deep into understanding how to measure and evaluate your investment returns. By the end of this video, you will have a comprehensive grasp of investment performance metrics, and you'll be able to leverage them to make informed financial decisions. Investment performance essentially refers to the measure of the return on an investment relative to the invested amount. It's the key indicator to assess the growth or decline of an investment over time. Let's start with some fundamental concepts. The simplest form of measuring investment performance is the return on investment, or ROI. This is calculated as the gain or loss generated by an investment relative to its initial cost. Imagine you invested $1,000 in a stock a year ago, and today it's worth $1,200. The ROI would be calculated as follows. While ROI is a good starting point, it doesn't account for the time period of the investment. To get a clearer picture, we use compound annual growth rate, or CAGR. CAGR is the mean annual growth rate of an investment over a specified period of time longer than 1 year. It's a more accurate measure as it accounts for compounding, which ROI doesn't. For instance, if that same $1,000 investment grew to $1,200 over 3 years, the CAGR would be. Another crucial metric is annualized return, which annualizes the percentage return on an investment. This is helpful to compare investments held for different lengths of time. Suppose you had multiple investments, one with a total return of 20% over 2 years and another with a 30% return over 5 years. Their respective annualized returns would be. It's essential to consider the risk associated with investments as well. The Sharpe ratio helps here by measuring the performance of an investment compared to a risk-free asset, after adjusting for its risk. For example, if an investment portfolio has an expected return of 10%, a risk-free rate of 2%, and a portfolio standard deviation of returns, risk, of 15%, the Sharpe ratio would be. But what if you want to compare the performance of similar investments? In that case, we use the Jensen's alpha, which measures the return of an investment over the expected return based on the market's risk. Consider an investment portfolio with a return of 12%, a risk-free rate of 2%, a portfolio's beta of 1.1, and a market return of 10%. The Jensen's alpha can be calculated as follows. Another performance measure is the Trainer ratio, similar to Sharpe ratio but uses beta instead of standard deviation to measure risk. For an investment portfolio with a return of 15%, a risk-free rate of 3%, and a beta of 1.5, the Trainer ratio is calculated as. Now let's address some frequently asked questions about measuring investment performance. Why should I use CAGR instead of ROI for long-term investments? Unlike ROI, CAGR accounts for the compound growth rate over multiple periods, providing a more accurate reflection of an investment's performance over time. What does a Sharpe ratio above 1 signify? A Sharpe ratio above 1 is generally considered good, indicating that the investment has a favorable return compared to its risk. How do I choose between Jensen's alpha and Trainer ratio? Use Jensen's alpha to measure investment performance relative to expected returns, and Trainer ratio to assess performance based on systematic risk. To sum up, understanding various investment performance measures such as ROI, CAGR, annualized return, Sharpe ratio, Jensen's alpha, and Trainer ratio can give you a well-rounded view of your investment portfolio's health and help you make more informed decisions.